We are in corporate financial management, and today we'll discuss the international aspects. That this is the last chapter of our syllabus. One foreign investor, what is looking? Good project, demand potential, revenue potential, a stable policy, environment, political, and also the government commitment and optimal risk allocation framework. Factors affecting foreign investment. Which factor affect? If we say shortly, rate of interest. What is rate of interest? For example, that company brings few amount as an FDI for establishing a company. For example, they want to go $100 million project. So they bring 30% amount. That means $30 million they bring to from their country to, for example, in our country. So 70% they have to take the money from the bank loan, because within this, that is your loan and equity. That means 70% loan they take for the establishing a company, 30% their equity. So here the interest rate is high. If high, then they cannot be survived, because they have to pay more interest expense than their expectation. But at this moment we have 9% interest in our country. Government declare it. And also not only that, at this moment there are few banks, they are giving only 7% interest for a good borrower, not the 9% also. So day by day our interest is decreasing. And some factor another, speculation, profitability, cost of production, economic condition, government policy, and political factor. That type of factor can be thing for an investor for investing to another country. Financing overseas investment. Financing overseas investment facility sometimes is medium term, long term facility, acquire overseas asset for investment purpose by investors of a country. This product will finance capital expenditure, such as the requirement of the machine and machinery item, and for working capital also shall be granted for the need purpose. So financing overseas, the financing overseas investment shall include, what is including? Purchase of investment asset such as property that provide cash flow, equity investment in the foreign company as a vehicle to gain asset to the market, obtain access to the supply of raw material or product, purchase of manufacturing facility, refinancing of the existing financing and investment overseas, etc. is the financing overseas investment shall include that type of item. Purpose of financing overseas investment. What would be the purpose? The purpose of financing is to finance a country's investor to undertake cross-border investment, that is investment to another country, cross-border, by way of purchasing overseas asset or purchasing of equity of overseas for the establishment. And here said that supporting the growth of development various field. And for example দেখানো হয়, যেমন আপনি মনে করেন যে সবাই চায় যে তার বিজনেসটা গ্রোথ হোক। এখন এক সময় বিজনেসটা যখন দেশের ভিতরে গ্রোথ করার পর বা দেশের ভিতরে এস্টাবলিশ হওয়ার পর, তখন দেখা যায় এটা বাইরের আসে। দেশের বাইরে যাওয়াটা মানে হচ্ছে আপনার গ্রোথটা, আপনার ডাইভার্সিফিকেশন হওয়া এবং গ্রোথটাকে এস্টাবলিশ করা, মানে মাল্টিন্যাশনাল আরেক দেশের সাথে যুক্ত। এই জন্য দেখেন আমাদের কি করে যে আমাদের কোম্পানিগুলি, গ্রুপ কোম্পানিগুলো এরা লিস্টেড হতে চায় না। কেন চায় না? কারণ লিস্টেড হলে তার বাইন্ডিংস এর ভিতরে চলে আসছে। আমরা দেখি পলিটিক্যাল রিস্ক এন্ড ফরেন এক্সচেঞ্জ রিস্ক। this now we are seeing that political risks and foreign exchange is the vital thing. Political risks is very vital because this risk is types of risk faced by the investor, corporation, and government. It is the risks that can be understood and managed with the reasons foreseen an investment. That means political risks. If we see this framework of the country risk analysis, how an investor analyze country's risks. So country risk analysis, there are few basic points. One is political risks, another competitive risks, another operational risks, and number 4, economic risks. So if we see the political risks, this political risks means employees exposure. That means if any country their political is that means unstable politics, government is unstable, and their kidnapping, hijacking, etc., harassment, if use that type of kidnapping. So that type of factor have to think, because investor come here for investing, and if they feel the life threat, so they will not invest with that country. So here political risks, and if we see the political risks, and if we see the competitive risks, and also operational risks and economic risks, look here, the shareholder exposure, how this asset distribution, that means where asset, that means explosion, asset immovability, transfer fees. For example, if you acquire few assets within that country after investing, if that asset you cannot transfer to your country, then you will not invest that country, and that country's government that freeze your all balance, cash balance or bank balance, then you will not invest that country. And also operational, that means market disruption, sometimes labor unrest. For example, you establish a factory, if their unrolling labor is there, unrest labor, huge problem is there, so that you will not be able to manage them, you will not invest that country, etc. And supply shortage, for example, if want your material for supplying, but material is the vital part for the production. So material, that means item, you will the shortage of that country, you will not go for the invest there. And business logistic, that means sometimes corruption, and network problem, etc. Regulation also, national preference, constrain the local capital, local content, local employment, tax, etc. For example, if you go for establish any company in Malaysia, even Singapore, there have the rules that 70 or 80% employee must be Malaysian. You will not give job to in Bangladeshi person for a Bengali company, or 30% nearly, you will be able to 30% employee. For example, you need 10%. Here 7% must be Malaysian. You have to employ Malaysian 7% out of 10. So that type of problem sometimes happen. And also tax issue and infrastructure, power, telecommunication, transport, supplier, etc. And economic risks is that economic growth, if unstable, and viability, inflation is high, and cost of input. So also cost of input is huge, and exchange rate, etc. So that type of factor can be within this risk spread framework for country risk analysis. An investor have to think very carefully: political risks, competitive risks, operational risks, economic risks within that country where the investor want to establish their business or going for the multinational. Political risks also known the geopolitical risks and become more of a factor as the time horizon of an investment gets longer. So here is another impact, that the causes of insecurity. That means if any investor invests If they insecure that type of investment, they will not invest. That means criminal attack, threat of organized. That means cause of insecurity. That is the cause. Ideological fascism, nationalist expansion, territorial disorder, economic explosion, etc., poverty, social exclusion, and risks of the loss of the life, risks of financial loss, threat of organization, that means criminal attack, political instability, economic volatility, legal challenges, etc. is the basic. Also, if that type of factor is existing within a country, so that scenario, and after analyzing that scenario, investor will not invest that country. So political risks are non-tremendously hard of the world. So there is the political. Now the foreign exchange risks. Also we can say the forex risks, exchange rate risks, or currency risks is financial risks that exist when a financial transaction is denominated in currency other than that of the base currency of the company. That means foreign exchange risks is the risks of an investment value changing due to change of currency exchange rate. The risks that an investor will have to close out a long or short position of foreign currency at a loss due to an adverse movement of exchange rate. So foreign exchange operation, if we see what would be the source of risks, international transaction by the export or import, and risk factor is that inflation, economic development, difference in real interest rate, central bank independency, country competitiveness, monetary policy of the country, expectation of the investors, and exposure of the risk, uncertainty, volatility in future transaction can lead to lose the change of the cash flow that is not expected. Well, there was a change in exchange rate that are not expected. It's make the loss of the organization through the foreign exchange. Major risks is foreign exchange operation is that here exchange risks, sovereignty risks, contingent risks, currency risks, position risks, liquidity risks, gap risks, that type of risks within the foreign exchange operation risks. Types of foreign exchange risks. So there are different types. One is transaction risks. Transaction risks, how transacted, and translation risks. What is translation risk? Translation risk means that conversion. For example, if you have another company in Singapore and also in your Bangladesh also. So if you convert or translate that amount, for example, in your parent company is Singapore and your business also in Bangladesh, when Bangladeshi profit or Bangladeshi here balance sheet or profit and loss account, if you translate into Singapore dollar, and that time exchange rate have to apply. So that time sometimes in beginning and closing, for example, if the 1st January, what was the exchange rate, and closing is the December exchange rate, that means basically a strong currency always is strong, and that means in our country's currency always they have the losing the purchasing power, and that's why including the inflation and translation risks come here. For example, in January, for example, 36 Bangladeshi taka equal to 1 Singapore dollar, or for example 60 Bangladeshi taka, one is Singapore dollar, and in the December if 65 Bangladeshi taka equal to 1 Singapore dollar, so here conversion, look here, just 5 Bangladeshi taka losing and within the year. So this is the translation risk, is the conversion of one currency to another currency, and another economic risk. So foreign exchange risk is an additional dimension of the risk which offshore investor must accept. That means investor have to accept it. As a result, open position in non-dollar dimension item may need to be closed, etc. So is the foreign exchange risk. So managing the foreign exchange risk. So this is the question in our CS. What do you mean by foreign exchange risk? How you would be able to manage it as a company secretary, suggest your board, etc. That type of question. So foreign exchange risk manage, how we will be able to manage it is an integral part of every company decision about foreign currency exposure. Many companies are exposed to foreign exchange risk, that is, the wealth is affected by movement of the exchange rate and will seek to manage their risk exposure. So here, currency risk, look here the economic exposure is effect of exchange rate on market share and profitability. Transaction risk, effect to exchange rate on foreign currency, denominated currency asset and liability. And also here, translation risk affect the exchange rate on translation of foreign subsidiary companies. Transaction risk, this is the risk of an exchange rate changing between the transaction date and the subsequent settlement date. It is the gain or loss arising on conversion. This is the transaction risk. If you open LC 100 million US dollar at the 1st of January and for 1 year, and the 31st December, that means you commitment, that means bank you just establish it this way. For example, 84 Bangladeshi taka equal to 1 US dollar. That type of exchange rate applied by the bank, and you also commitment, that bank commitment in that, you also giving the LC commission, margin, etc., all the same figure. And 31st December, this rate go for 90 taka 1 BDT equal to 90 taka BDT 1 USD. That what would be happen? This is the exchange rate. That's why banks, that type of risks go for the swap also, and that's why we see that option, there are call option, put option. The bank are minimizing that type of risks through that type of option, and in other country that type of option also sellable in the capital market. But we have no that type of issue in bond market at this moment. A Securities Exchange Commission going for establish that market, and you have seen that the news also, there are 11 banks, their perpetual bond also going for the direct listing to the security market, stock exchanges. So here what we are saying, that exchange rate changing between the transaction date and the subsequent settlement date, it is the gain or loss arising on conversion. These types of risks is primarily associated with the import and export. If a company export goods on a credit that has a figure for debtors in its accounts, the account will be finally received depends on the foreign exchange movement from the transaction date and the settlement date. As transaction risk has a potential impact on the cash flow of a company, most companies choose to hedge. One other thing is hedge financing also, hedge fund. There are a lot of issues. Also, there are hedge fund accounting standard also, and it is the most probable countries is Sweden, Norway, etc. That type of country, they are doing that type of financing, hedge finance. In Sweden, there is big company now. Name is Brammer and Partners, AB. Brammer and Partners. So his fund management is also a fund management against such exposure. Measuring and monitoring transaction risks is normally an important component of treasury risk management. So it's also a treasury function. In every bank, they have the treasury function. The degree of exposure depends on the size of the transaction and its materiality, the hedge period or time period before the expected cash flow occurs. The anticipated volatility of the exchange rate during the hedge period and the corporate risk management policy should state the degree of exposure of the acceptability. And if we see here, potential seller is here. Look, here order to broker. If broker reject the order, it's okay. If accept, then go to the market. And here, through the clearing completed, and broker, if broker, that means here potential buyer, here potential seller. So transaction between the broker, here buyer taking one broker, seller also broker, and within the market, and completed the clearing center. Also, you can say that type of transaction happen in our capital market also. Within a market, here buyer, seller, and based on the supply demand, price is depending. Economic risks. So here a type of economic risks, yet again Wall Street Mojo from taken, solvency risks, unexpected switching to the exchange rate, credit risks. The transaction exposure focus on relatively short-term cash flow effect. Economic exposure encompasses that plus longer term. What is saying that there are two ways in which companies export their economic risks. One is directly, another indirectly. What is directly? If the company home currency, so if our company, so our home currency is Bangladeshi taka. If Singapore company is home currency is Singapore dollar, etc. Strengthen the foreign competitor are able to gain sell or buy expense because of their product have become more expensive in the eye of the customer, both abroad the home. So here is the directly, that means if the home currency is strong, then foreign currency, then they can be approached directly. And because, for example, if you take US dollar and go anywhere, everywhere is acceptable, and you can change the local currency also. But if you take only BDT Taka or Indian rupee or Pakistani rupee or Noakhali Taka, if you take it, but you cannot fly other country, you cannot exchange. And but within our country, we can exchange it. So here, a strong currency is US dollar. So if the home currency is strong, then foreign competitors or foreign currency countries then directly can be approached for the economic manage for the economic risks, and sometimes indirectly economic risks, translation risks, and here the foreign exchange hedge process. This way, hedging involve the foreign currency lead to leading, matching, forward contract, money market hedge, future contract, option. So look here the option. A currency option is a right but not an obligation to buy or sell a currency at an exercise price on a future date. If there is a favorable moment in rate, the company will allow the option to lapse to take advantage of the favorable movement. And there are two things, call option, put option. So এটার জিনিসটা অপশনটা এমন হচ্ছে যে আপনার এমন হলো যে ব্যাংকের সাথেই যেটা ঘটে, আপনি ধরেন 100 মিলিয়নের একটি ধরেন $1,00,000 একটা এলসি ওপেন করলেন। আপনি এমন করলেন যে এখানে এমন হলো যে আপনি ওপেন করলেন, ব্যাংক কি করবে, ব্যাংক হইতে একটা অন্য কোনো থার্ড পার্টির কাছে রিস্ক মিনিমাইজ করার উদ্দেশ্যে এটাকে হয়তো সে অপশনে নিতে পারে। ফর এক্সাম্পল, এমন ব্যাংক যদি এমন করে কোনো একটা কোম্পানির সাথে, অপশনে কিন্তু আলাদা কোম্পানি আছে, ওরা হলো ব্রোকার, তারা এটার জন্য কমিশন পায়। তো সেটা এমন হলো যে আপনার সাথে কমিটমেন্ট হলো 1 বছর পরে অথবা 9 মাস পরে আমাকে ওই $1,00,000 পেমেন্ট করতে হবে, এটা একটা কমিটমেন্ট। এখন এই ডলারের দামটা আজকে মনে করেন আসে $80, 1 বছর পরে কত থাকবে সেটার কোনো নিশ্চয়তা নাই। এবং 1 বছর পরে আপনার যদি ক্রাইসিস হয় তখন থেকে মার্কেট থেকে বেশি দামে কিনতে হবে। এখন ব্যাংকের সাথে ক্লায়েন্টের সাথে একটা সম্পর্ক আছে যে তার সাথে একটা এগ্রিমেন্ট হয়েছে একটা স্পেসিফিক রেটে। এখন ব্যাংক কি করবে, এই যে মনে করেন তার সাথে এরকম রেট হলো যে 80 বা $81 হলো, 81 বাংলাদেশি টাকা, 84 ধরেন, 84 টাকা সমান সমান $1 হিসেবে ধরে আপনার সবকিছু অ্যাকাউন্ট ফর হলো, সবকিছু তার সাথে এগ্রিমেন্ট হলো সবকিছু। এখন ব্যাংক কি করলো, একটা থার্ড পার্টি একজন অপশন ইয়ার কাছে গেল, যে বললো যে আগামী 9 মাস পরে আমার $1,00,000 লাগবে, তখন চাইলে তুমি কত করে দিতে পারবে, এটা তাকে বেঁধে রাখা যে 9 মাস পরে আমার যেন এই কমিটমেন্ট ফেল না করে, এবং যেন নিশ্চিতভাবে মার্কেটে যত ক্রাইসিস হোক, আর ক্রাইসিস নাও থাকলেও আমার $1,00,000 আমি পাবো, এটাকে কমিটমেন্টটাকে এস্টাবলিশ করা। এই যে অপশন কোম্পানি আছে তারা কি করবে, সেও হিসাব নিকাশ করে বলবে যে 9 মাস পরে আমি এমন হলো যে এখন তো ধরেন ওর কাছে হিসাব করলো 84, ঠিক আছে, আমি 86 টাকা পার ডলার হিসাবে আমি তোমাকে দিব 9 মাস পরে। তাই কি করতে হবে, এই জন্য হয়তো 0.10% টোটালটার উপরে একটা কমিশন তাকে দিতে হবে। এই কমিশনটা হচ্ছে ওই কোম্পানির লাভ, এইটাই নিয়ে চলবে। এখন 9 মাস পরের ঘটনাটা কি হবে, তখন যদি মার্কেটে এমন হয় এই ডলারটা তখন আসে হলো মার্কেটে হলো 85 করে, কিন্তু ওনার কাছে কমিটমেন্ট হয়েছিল 86 করে। এখন আপনি যদি ওনার কাছ থেকে কিনতে যান তাহলে আপনাকে কিন্তু 86 করে টাকা দিয়ে কিনতে হবে, আপনি কিন্তু কমাতে পারবেন না, কিন্তু আপনি মার্কেট থেকে পাচ্ছেন 85-তে। তখন কি করবেন, তখন আপনি তার কাছ থেকে আর কিনবেন না। এই জন্য এখানে বলা হয়েছে a currency option is a right but not an obligation to buy or sell a currency at an exercise price on a future date. ওই যে এক্সারসাইজ প্রাইসটা হচ্ছিল $86, মানে 86 টাকা হচ্ছে পার ডলার, এর এক্সারসাইজ প্রাইস। এখন এটা কিন্তু একটা বলতেছে এটা একটা রাইট, আপনি কিন্তু ইচ্ছা করলে এখন ওর থেকে নিতে পারেন, কিন্তু আপনি যেহেতু দেখতেছেন, কিন্তু এটা কোনো অব্লিগেশন না। আপনি যদি এমন চান যে না আমি মার্কেটে আমি কমে পাচ্ছি, আমি কেন ওর থেকে বেশি নেব, এটা গেল একটা। যদি চিত্রটা উল্টা হয়, মার্কেটে তখন হলো 88 টাকা, কিন্তু ওর সাথে কমিটমেন্ট ছিল হলো আপনার 86 টাকা, তখন কিন্তু আপনি এটা এক্সারসাইজ করবেন এবং আপনার তখন রাইট, আপনি তখন নেবেন এবং সে তখন দিতে বাধ্য, কেননা আপনি তাকে এটার জন্য কমিশন দেওয়া হয়েছে এবং তার সাথে আপনার এগ্রিমেন্ট হয়েছে। এই জন্য এটা বলছে if there is a favorable movement in rate of company will allow the option to lapse to take advantage of the favorable movement. তাহলে দেখেন এখানে দুটোটার ক্ষেত্রে যখন আপনার মার্কেটে কম দাম ছিল আপনি বেশি দাম নেবেন না, এটা আপনার জন্য ফেভারেবল বা অ্যাডভান্টেজেস। আবার তখন মার্কেটে দাম বেশি, আপনি ওর থেকে কম নেবেন কারণ কমিটমেন্ট আছে, এগ্রিমেন্ট হয়েছে, এটাও আপনার জন্য ফেভারেবল। তো সেটাই, দ্যাটস ওয়াই they had said that a currency option is a right but not an obligation to buy or sell a currency at an exercise price on a future date. If there is a favorable movement in rate, the company will allow the option to lapse. to take advantage of the favorable movement. The right will only be exercised to protect against the adverse movement, the worst case scenario. So there is two options. One is call option, another is put option. So what is a call option? Call option gives the holder to right to buy the underlying currency, and put option gives the holder the right to sell the underlying the currency. So who is selling? It is the put option. Who is buying is the call option. So here it is the basic thing is that option is a right to buy or sell an asset at a fixed price on or before a given date. Right means buyer of option has no obligation, seller to option to obligation. Call means a right to buy, put means the right to sell. Also here is a same way. Now forex swap. Foreign exchange swap, the party of agree to swap equivalent amount of currency for a period and then re-swap them at the end of the period at the agreed swap rate. Just like option, the swap rate and amount of currency is agreed between the parties in advance. Thus, it is called a fixed rate or fixed rate swap. So here, how they work this way. First of all, identify the major foreign exchange exposure. Then 2, develop the company's policy. 3, hedge exposure using trade and or other technique. 4, evaluate and adjust periodically. So this way it comes swap and also some currency swap. This is your question. So here we can say that the swap of interest rate could be fixed for variable. So this is your question. Look here is the January 2020 last year, question number 4A, 5 marks. Your question is that what are the external techniques of foreign exchange risk management discussed in briefly? So this would be here. Risk is an inspector element of foreign market. Risk being a primary element in this primary. This way you can justify. There are various foreign exchange risks. Some are internal, some are external. Here saying it is the technique of foreign exchange risk management. How to manage the foreign exchange risk. In your question is said external. So through the future option, through the forward contract, through the option, through the swap, through the gold, dinar or dollar, etc., transfer pricing, back-to-back loan, etc. This is the external factor for foreign exchange risk management. And within that external also we have the internal factor, some that means leading and leasing, invoicing, sourcing, browsing, matching, commodity hedging, etc., browsing and lending, etc. So that type of question you have 5 marks. So here for what is forward contract, where is future contract, what is option, etc. So it's a question also. You are the company secretary. The management of the company is currently considering listing on the Dhaka Stock Exchange as well as Chittagong Stock Exchange, your company. Can you identify 3 stakeholders with the regard of the listing of the state clearly their goals? So that answer would be that one. So shareholder in the company, employee in the company, who would be the benefited or a stakeholder, government, 3 stakeholder. And another, it is the calculate the weighted average cost of capital using the above information, beta value, etc. So from this math, we are calculating the weighted average cost of capital Here another math from the capital budgeting. Optimum replacement cycle is a good math here. And try today, and I think next class I will do another different types of math. I will take it. And this one is a problem. Is this type of problems also come in your exam also? Equivalent annual, the same to same math. Here's 54. So today it's all for today. Today we are going for finish the chapter. This is the last chapter of our corporate financial management. International aspect, we discuss the multinational operation, foreign investigation, financial overseas investment, political risks, foreign risks, and manage the exchange rate of risk. So I think we'll see you in next Sunday, inshallah, and with few new maths and other thing. And okay, sir. And within this time, if you face any problem or any math, just copy it and send it to the WhatsApp. I will be able to, that inshallah, I will take it, that is giving you the answer also. So any problem, just knock me through the WhatsApp. Okay, sir.